Welcome back, guys, to another sensational podcast with MYB. In today's session, guys, we can talk about the stock market. We can cover the stock market, the ETF, bonds, whatever you need. We can cover it, guys. But before we start, you guys all over the world, you guys know it by now. You're alive, man. You guys are watching this video right now. It's Friday. Some of you guys be safe during the weekend. Whatever you guys do, be safe, be productive. But before you start your weekend, though, make sure you post that content. Do what you have to do to secure your future self. You see what I'm saying, people? So with that being said, people, gratitude, Lord, for life. Gratitude, Lord, for strength. Gratitude, Lord, for your provision. Gratitude, Lord, to shining your light upon me, Lord, for you guys out here watching the video, man. Like I said, whatever you do today, do it to the utmost best. Like I said today, guys, what we can talk about, we can cover the stock market. We can talk about stocks versus bonds versus ETF, the explanation, right? Because a lot of people, guys, in the stock market, but they just day trade. If some people don't even day trade, some people just invest. Some people just buy like one or two stocks, right? They don't even buy bond. They don't even buy ETF. They just buy like maybe the 7 tech stock. We got the Apple, the Microsoft, the Meta, the Google, the Walmart, the Tesla, the Nvidia, the like I said, the Intel. They just buy like stocks, which is fine. You could do that. You know, people, as long as you buy the stocks and you collect dividends. You know, people. So most people, right, here's the term, I'm buying stocks. Like I said, I'm investing in bonds, I'm stacking ETF, but they can't really tell you what they are, right? Really own and how their money or which their money fit their goal. Because like I said, you don't, like I said, at least you're at least investing in the stock market. You know what I'm saying, people? Because like I said, you don't have to like know what it is. Because like I said, tonight some of you guys are going to the clubs, bro, and you're gonna have a one night stand with a female, or a one night stand with a dude, and you have no idea who that person is. You know what I'm saying? Same with the stock market, same with the bond, same with the ETF. You don't know what it is, but it's fine. At least invest in it because it's gonna generate income, right? If you play the puts on it, and if you buy the option, at least you might have a date. But if you buy the shares, like if you buy, not even buy shares, at least you invest like $20, $10, $50. You invest in it one term, it's gonna still pay you dividends, right? So check this out. If the company makes money and growth, your stock's value goes up. If the company struggle, your stock value drop. It's simple but powerful. That's the same with the stock market. Like they definitely say the stock market is risky, high risk, high return, but it don't really care because if you have shares in the company, it's different. Because even though you have shares in the company, right, and the stocks go up, you make money, right? If the stock go down, you still make money because you're getting paid off the dividends. So normally, what I do, I look up for dividends that pay me weekly, dividends that pay me monthly, and dividends that pay me yearly. I'm yearly, right? So anyway, if the stocks go up or down, I'm still getting cash flow. Right? Think about it, people. Cash flow is the ultimate goal, right? So there are two main types of stocks payoff. You have the capital gains. That's when the price go up. You buy low, you sell high. But I don't like the principle buy low, sell high. I like the principle you buy low, and when it get high, you go to the bank and you borrow. Because the minute you sell, especially when you, for example, let's say you actually hit like 10K, 20K, or you hit a good sum, when it's time come to sell, Caesar, they're gonna tax you on that. So if the worst case scenario you want to do is sell, because the moment you sell, you giving away like 30%, 20% of your gains to the tax, right? But if you take your phone and you walk into the bank and you borrow against that, right? And when you borrow against that now, don't just borrow against that to just buy, oh, I made it, let me go. No. If you finna borrow against your stocks, put that home on some real estate, bro. Put that home on a down payment. Because let's say hypothetically you hit for 20,000, you borrow against that, they're giving you like 75% or 90% of the profit. So if they give you like probably 15,000, you can put down 15,000 for a bank, and the bank might give you 45,000. You know what I'm saying? Take that 45,000, put that home in 3 properties right there, down payment for like maybe $10,000 down payment on each property. Get your housing market going, and that's off one stock. You know what I mean, people? And that's because you didn't sell. You buy low, you hold on, and then you freaking keep the cycle going. Because the moment you sell, like I said, they can tax you. And next we can talk about dividends, because dividends is the ultimate cash flow. Dividends, and it's something called the cover calls and something called the wheel strategy. Those three is generate you cash flow regardless, right? So the dividends is basically, that's when the company shares a profit with the profit you with. You know what I'm saying, people? The profit they make, they give you a piece of that. You know what I'm saying? You giving them your money, and they just giving you bread every month, every week, every year. Depends what company you go with. Like I said, when you're looking for dividends, do not go for no dividends like what have 8% or 10%, because those are not realistic, right? Go for companies that have dividends. Look at Yahoo Finance. When you do that, the technical analytic shit, look for companies that give you guys 2 to 3 dividends ratio, because 2 to 3 is sustainable and there's always room for growth, right? When you're already at an 8 to 10 dividends, there's room to come down. There's no room to growth. Those companies are high liquidity, high volatile. It's not realistic in the long run. Yes, you might get it for like 2 to 3 months, you know what I'm saying? But eventually, it will come down. So with that being said, people, here's the catch, right? The stocks come with risk. The market can swing, news can hit, and one bad quarter can shake everything. There's a guy called Jerome Powell. His journey about to be end February. So right now we're waiting on a rate cut. If he decide previous rate cut, he did it, but the rate cut what he just did was like, what, a quarter point? Like, if you finna give people a rate cut, like, cut the shit. You know what I'm saying? People cut it by a dollar or half a point, but bro cut it by a quarter. So yeah, people did get the rate cut, but is it really a win? You see what I'm saying, people? Because the way he did it, bro. But whatever bro said in the stock market, that's the only person who have the power to affect the stock market. Him, and if Donald Trump decides to just talk about China. Those two will drastically affect the market. But if you're day trading and you're doing the investment, you're gonna profit regardless. Because the moment Trump opened this mode, oh, we're gonna attack China, we're gonna tariff China, bam, the market go down. Just place a put on the same day and ride that wave down, right? Same with Jerome. Soon as Jerome go on TV, bro. Soon, see, but Jerome now, when Jerome talk, it's time to hedge. You got to bring out your hedge fund. You got to buy calls and put. Because when Jerome talk, the market going both ways. But for Trump, every time Trump talk about China, that shit going down. There's no both ways. Only Jerome got the power to make the market go up and down drastically in damn near one situation, right? So that's pretty much all stocks is, right? Stocks is just you buying one shares, one that dividends, but it's just one company. It's not a bundle of company. It's just one company. Like Starbucks. Starbucks is one company. You only buying some shares. Starbucks right now at $82 per share, right? So example, if you buy $82 a share, that's one share. And whatever Starbucks do, they do. If the stocks go up, you get paid in dividends. If the stocks go down, you still get paid in dividends, right? But it's still one stock, right? So next one we can talk about bonds, right? Now let's chat about bonds real quick, right? Bonds are the complete opposite of stocks, right? When you buy stocks, you own a piece of the company, right? When you buy a bond, you're lending money to a company or government, right? Same with the central bank. When the central bank print money, they can't spend the money. They got to swap that shit for bonds. Pretty much an IOU, right? Think of it like this, right? Here's the bank, right? They borrow money from you, and in return, they promise to pay you back with interest and principal, right? So it's go off trust and debt. If you can't pay that back or they can't pay that back, know the one, they can call up central bank and print it. If you can't pay it back, so what? The country already in debt. So if your company says, think of it, people, if you're ever borrowing from the bank, bro, borrow so much money that if you fail, the bank itself is gonna bail you out. Because think about it, right? You go to the bank, right? And you get them a borrow. You want to borrow $5 million. Sure, bam. You put up your assets, they give you $5 million, right? You cannot pay back that $5 million. You lose. You're in trouble, right? You're in trouble because why? It's only $5 million, so you're in trouble. Now, check this out now. You go back to the bank and you borrow $90 million, right? So now you borrow $90 million. They can give it to you still because you got your credit, you got your asset, whatever. They give it to you. Now, when it's time come to pay back that $90 million, you can't pay that back, right? So you're not in trouble. We are in trouble, right? And who is we? The United States, the bank, we are in trouble. So now they have to come and bail you out because 90 million not just affect you, it affect the whole country, right? Vice versa. If you only go for borrow $5 million, that only affect you because that's a small cash flow. For example, let's say you buy a $1,000 bond from the US, right? Government with a 5%, let's say 5% interest rate, right? That means they pay you $50 a year, right? And after that bond expire, you get your $1,000 back, right? Simple, right? It's simple, but it's still, some people wouldn't get it. If you don't get it, I don't care. Right? I can care less if you get it. As long as my kid, when he watches in probably 20 years from now, he understands what I'm saying. That's all that matters, right? So, simpler, right? But check this out. That's why bonds are called fixed income investment, right? They give you steady return, less drama, and more predictability. That's the same with the CD. CD is pretty much the same category as the bonds. You know what I'm saying, people? CDs, if you open a $500 CD or a $1,200 CD, you're leaving that CD there for like 6 months to a year, right? You're not touching it. You're not doing that. If you take out money within a time, you get penalty. I should cover CD in this, but since I'm already talking about CD, I might as well go with it, right? So the CD principle is the same. As long as you don't touch the money, you're guaranteed at the end of the 6 months you're getting a return. Even though the stock market crashes, everything crashes, the CD is guaranteed because it's backed by the FDIC, right? But then again, is it really backed by anything? Because from Nixon take the dollar off the gold, the US dollar wasn't backed by anything. Same with Bitcoin. Bitcoin is not backed by nothing, but Bitcoin is the backer. Then everything run off Bitcoin, but nothing back Bitcoin. Same with the FDIC, right? Because from they take the dollar off the gold, the US dollar was not really backed by anything. You know what I'm saying? Then they try to link it with oil. So other countries to buy oil with US dollars. So they try to remove the gold, but try to have like a lever with oil. But still, you know what I'm saying? People, similar with people. So here's the trade-off, right? Less risk, like I said, less reward. Bonds won't double your money like a hot stock, right? But they protect your money. That's why big investors use bonds to balance their profit. Same with the bank. That's what the bank do, people. The bank take your money. For example, when you go to the bank, right, you put in your deposit of $1,000, $10,000, whatever. They take like 90% to 80% of that and put that home in bonds, bro. Right? Put that home in bonds and make money with them. The bank is, look at the bank looking like a hedge fund, right? But they buy safe, secure asset, right? Safe, secure asset that's gonna make them money too. So even if these banks fail, JP Morgan, Wells Fargo, Bank of America, Lehman Brothers, they those right here, the bank by itself will not fail because why? The government is gonna bail them out. Because if the government don't bail them out, the taxpayers is gonna get hit worse because you guys have a lot of your cash flow into those banks. So if you guys would come together, because your last name, everyone with your last name should create your own bank, right? So if you guys come together with your own bank, put that whole in LLC, put that whole in revocable trust, have a beneficiary, like a credit union situation, like an island lock situation. Every month, every week, someone get a payout. You will need a bank. Then those banks will fail because the taxpayers don't have the money in those banks. So then when those banks do fail, it will fail. So then the phrase too big to fail will not exist because no one have their money in Bank of America or no one have their money in Lehman Brothers. You see what I'm saying, people? So when stocks are crazy, bonds keep growing. When stocks fall, bonds often rise, right? That's the power of diversification, and we talk about that more in like a couple more seconds, right? So that's the difference between the stocks, the bonds. Even though stocks come down, that's so what. Bonds is gonna always grab because every time the reason why bonds is gonna always go because that's every time they print money. Because every time they print money, they cannot spend the money. Central bank cannot spend the money. They have to buy the bonds for the money. So they have to swap that shit to an IOU situation. So the bonds is gonna continue to rise regardless. And when you buy a bond, I mean, like I said, when you put your money into bond, it's gonna always grow. You know what I'm saying, people? Because that's where the bank have their money. You know what I'm saying? That's where the smart people have their money, into the bonds. And you guys could even trade the bonds on IBKR, like a broker, and you can short the bonds or do whatever you want to do with the bonds, right? And then ETF and other hand, it's a slightly different, right? So this is where it gets good, right? ETF combines the best both of worlds, right? ETF is a for example, you can have 10 bonds and you can have 10 bonds together. That's ETF. You can have 10 stock together. That's ETF. ETF is anything that combines together. That's pretty much a short term if you read it. Anything that combines together is ETF, right? So think about it, right? ETF combines the best of both worlds, right? They give you diversification like a mutual fund, right? But flexibility like stocks, right? Here's how it works, right? An ETF holds a basket of different investment. It could be the S&P 500 and bonds, like I said, or crypto. Like if you guys, for example, let's say crypto. Let's say crypto. You have XRP, Bitcoin, ETF, Solana. Those four stocks, you buy all four of those together. That's an ETF by itself. You know what I'm saying? Because you have four stocks. So now your portfolio diversified with four companies. So even though Bitcoin crash, the other three might hold up. But knowing Bitcoin, when Bitcoin crash, everything going, the whole crypto going down regardless. Only one of those meme coins might get lucky. Same, remember earlier we talked about the stocks. So now we have Intel, Tesla, Microsoft, Google, Amazon. We buy all five of those in an ETF. Now we have five stocks right there. We don't just have one. We diversify in five. But the thing about diversification now, never get stocks in one tech. Yes, your portfolio diversify, right? But it's still trapped in technology. right? So with how you want to diversify, you want to have like one sector in technology, one sector in consuming, one sector in shipping, one sector in warehouse, one sector in water, one sector in minimum in gold, like some same people, and all of that combined into the ETF, right? So when you buy one share of an ETF, you're buying a little piece of every company inside the basket, right? Instead of buying Apple, Amazon, Microsoft, and Google individually, you're buying all of them together, right? So the best way you can buy the platform is ETF called VOO, VOOO, or the S&P 500. But a lot of people say the S&P, I mean, a lot of beginners for sure. Like when they go jump into trading, they always say to grow your money, put it at the S&P 500. It's better. I would say it's better. I may talk about it later, but I wouldn't talk about it in this podcast. But my diversify dividends portfolio, I have better way of having my instead of S&P 500, I have something called SCHD. Look at that, SCHD. I have my money into there. So like I said, people, it's different ways of you can diversify your portfolio, right? So don't just look into stocks and be like, stocks is the way. If you guys get into the stock market, completely fine. At least you're in that hole, right? So that's why ETF are preferred for beginners, because it's less fee, it's easier to trade, and it's build diversification. But how you diversify it, because remember I told you guys, I don't know if you guys follow in the channel or whatever, but I told you guys, yes, you diversify, right? But you only diversify in the US, right? So let's say the United States crash, you're trapped in the United States. You have to be diversified outside the United States. Get you some companies in China, Alibaba, JD, NTIS. Get you some company in Russia, in Spain, in Europe. Get you, and then hopefully you guys go over there. Get you guys some passport. Get you guys on bank account. It's a whole different variety I can talk about. But let's come back real quick to the ETF, right? And it's the best part, right? ETF trade just like stocks. You can buy them, sell them, or hold them for long term, right? They're flexible, affordable, and powerful for building wealth over time, right? So check this out, right? What you guys learned so far, the stocks is better, the bonds are better, or the ETF, whichever one your strategy, because the truth is, right, no answer, no one is really good, right? The best thing you can do, what I'm gonna tell you guys, because I'm doing it, is I get all. I get all of those. I get all of that. On top of that, I even get the REITs, right? The REIT. I even get the REITs, return investment interest. I'm some shit like that. I'm brain fog right now, but you could also get the REITs, right? Because think about it, right? If you're young and you want to grow your money fast, stocks might be best friend, right? But if you're older and want stability, bonds give you that protection, right? And if you want to balance diversification and ease, ETF might be the best way to go. But like I said, I'm not gonna tell you guys what to do, because I don't care. I don't care what you guys do with your life, because I'm doing this for me, and I'm gonna grow eventually in the future. And the more I can talk about this to you guys, the more I'm learning it. Because for you to teach something, you have to know it, and the more you teach it, the more you know it, and the more you know it, you can talk about it, and the more you can talk about it, the better your understanding of growth for it become, right? So a lot of small investors mix them, right? Maybe 70% in stocks, 20% in bonds, 10% in ETF. Like I said, however you is, what you plan to do with it is you, because end of the day, as long as you have them, and you implement it, that's all that really matters, right? So how I personally use each strategy, right? So I use stocks for growth, and I use day trade to make the cash flow faster, because I use trade locker to stack their bread. I use bonds for that stability, because regardless of what happened, the bonds is gonna win, right? Think about it, people, right? And also you can use the ETF for passive dividends. Like I said, people, remember I talk about the dividends. The dividend is the key. So using the ETF, like getting you like a bundle of stocks, and just have that for just dividends. Like you're not touching the stocks, you're not selling it. If you guys put $5 into it, $5 in 10 stocks, right? 5, 10, 15, 20, 25, that's almost $50 right there, right? Into 10 stocks, and never sell it. Like I said, we don't sell, we borrow. So you hold these 10 stocks, and every weekly and monthly and yearly, these stocks just pay you dividends, right? That's the ETF right there, right? And then you can have your regular stocks, your 1 or 2, 3 stocks. Then you can have options, an option call or option long, right? Or when you guys reach a damn near 50K to 100K or 25K in your trading account, is something called the cover calls, right? Cover calls, as long as you can buy 100 shares, you can buy a put spread and a call spread, and then you can leave it for the expiration date, because as long as the company consolidating, and you have to be willing to buy 100 more shares when the company drop. But who really cares, because it's a company you like, right? And then you're gonna keep generating cash flow regardless. Then it's like the wheel option. You got something called a wheel strategy. You do the same thing, but the company have to be in a bullish run. You say you want the company to go up. Then there's something called the leap option. Leap option, you buy a company for like 2 to 3 months out and you just leave it. Or a leap put, vice versa. Or you can just day trade. I wouldn't recommend you guys day trade, because day trade is a lot of emotional and you're fighting time decay, right? So hope today talk about stocks, building wealth, bonds, protect your wealth, ETF balance. Because think about it, people. You get you the stocks, you make that $10, right? You take that $10, you put it into bonds for protection. You take the next $10, you put it into the ETF to collect you the dividends, right? So remember this, right? We don't work for money, bro. Money work for us. Like I always said, bro. Butters is discipline. Butters is consistency. Butters is sharp. Butters is invested. And I'll see you in the next one. Mind your business.